Hey everybody, and welcome back to H Invests. Very exciting video today. 5 ways to tell if there's going to be a stock market crash. Had a lot of fun putting this one together. Obviously there's not going to be one single method like in isolation that will, with certainty tell you the magic formula for when there's going to be a stock market crash. But I really think, putting these 5 ways together, if you understand them in the video going forward, it will give you a really good idea as to what might be indicating a stock market crash in the future. So let's get into it. Number 1, the Shiller PE. So most of you guys have probably heard of the price to earnings ratio. What the Shiller PE is an extension for that. It is for the last 10 years. So the earnings are averaged out over the last 10 years, and it's also adjusted for inflation. So it's real earnings. Why 10 years? Basically just to even out the cyclicality of earnings in the market. And obviously after inflation, it wants to measure the real growth of the companies, not just the companies that are just being carried along by increasing prices. So Robert Shiller, famous economist, came up with this. And obviously a higher Shiller PE would mean that the market is more expensive for each dollar of earnings. So we're looking at kind of the whole aggregated price to earnings of the S&P 500, and we can see we're currently at a pretty high level. Look at this, 33.82. So we're currently at a pretty high level. The mean is 16.78. I've highlighted that in red on the chart. Median was pretty similar. You can see a minimum. Where was the minimum? In the depths of the 1920s. This was before the roaring 20s, quite interesting. And he had a max of 44 at the dot-com bubble. So effectively, Shiller describes this being mean reverting. In the long run, you can see you might have some above the average of 17. You might have some below it, but in the long run, it's mean reverting to that red line. So this would indicate the stock market at the moment is pretty overvalued on a Shiller PE basis. However, what some people say with regard to this is we've actually never been in a time of such low interest rates before. You can see the federal funds rate. If anybody can't see the x-axis, that's from the 1950s all the way to 2020. And we've never seen such low interest rates between the GFC and about 2017, and then they were cut again in 2020. And what this means is that with the interest rates so low, this PE might not be so bad because the opportunity costs of investing in the stock market is very low. Because the alternative bonds, look at this, US federal fund rate, current target between 0 and 0.25%, 10-year US Treasury rate, 1.11%. If we do the reciprocal of the price to earnings ratio, which will give us the yield, that gives us a yield of about 3%. And when you compare those together, it's a no-brainer. So it's interesting. Shiller's data shows that in the long run, there is this mean reversion to 17, but then at the same time, with the interest rates so low, it has reduced the opportunity costs of not investing in bonds because the yield on bonds are so low, and therefore more people are investing in stocks, but discount rates on the free cash flow models are lower, and thus the PE ratio is higher. Okay, number 2. This is probably the most technical one on here, the yield curve. Very, very, very important though. I think I will do a full video explaining this in much greater detail, but the real basics of what you guys need to know for this exercise is you're looking at a curve which is flat or even inverted. So if you're looking at the PowerPoint, on the left, you want it higher than the right. We've got short-term treasuries on the left, long-term treasuries on the right. The yield is on the y-axis. And when it's flattening or inverting, that's a sign there could be a recession on the rise. This has been very strong for predicting recessions and market crashes. Look, all 7 it has predicted recently. You've got an inverted yield in 2000. There was one before the GFC. And actually we did see one, just a little one in August, but the spread has remained very low. I'll explain the very basic rationale behind this now. If you're an investor, what's the safest thing you can invest in? Long-term US Treasury bonds, right? If you're investing in US Treasury bonds, the reason that they're so low risk, US government, largest economy in the world, massive population of high earners to tax, and also it can just print money. So the probability of it defaulting on its debt is incredibly low. So what will happen is when investors feel bearish, what they'll do is they will buy in to these long-term bonds, right? And what will happen is that will increase the price because there's increased demand, and therefore it will push the yield on the bonds down. So that's what we're saying here. We'll push the yield on these bonds down. And yeah, we did see one in August 2020. We haven't seen the crash yet, but you know, this one was in late 2006, and we didn't see kind of the big crash in a recession until 2008. So the yield curve has been a very strong indicator historically. We saw a little dip in 2020, not quite as significant as we've seen in the past, but still a very strong indicator nonetheless. Okay, number 3, the AAII Investment Survey, which is the American Association of Individual Investors. So this is just a survey of people who kind of invest their money for themselves professionally. They're investors that take the game seriously, and you can just kind of see their general sentiment. You can see one wise way to look at this is compare it to the historical average. I will just say something that confused me about this data a little bit is I think they should probably put bullish in green and bearish in red, because when I initially looked at it, my brain was just like, boom, bullish is green. But it's actually the other way around. So that's just something to note. Yeah, the best way to do it is compare it to recent trends, compare it to historical averages. We can see that the amount of bullish investors is roughly in line with the historical averages, but less investors are uncertain and more investors are bearish, which is very interesting to see. So there are less investors on the fence. And you can see the general trend from the last few weeks has moved around a lot, and investors are much more bearish. So yeah, that's indicator number 3. But data obtainable straight from the AAII website. You can even sign up for yourself. It's $1. I thought this was quite smart because it's $1, so it defers people from just signing up again and again and again and voting. But then at the same time, it's not, you know, ridiculously expensive that it's off-putting. So that's a very useful indicator to look at, and it's on a 6-month basis. Okay, so number 4, the volatility index. You guys probably heard of this as the fear gauge. So it effectively measures the options on the S&P 500, and it measures their volatility. So when we see a market crash, we usually see much higher volatility. So when we see the option price going all over the place and being really high, really volatile, that's an indication we could see a market crash around the corner. And you can see historically, the VIX has been very high, both when we kind of had .com and 9/11 and the whole bear market from 2000, 2002. And it was its highest point in recent history in the global financial crisis. Again, if people can't see, this is a 30-year graph. And recently we did see a big spike in option prices. This is probably to do with what's going on with GameStop and some other stocks, and Redditors pushing up prices of highly shorted shares. So that might be why we're seeing option prices going up. And something a lot of people don't know about the VIX is, so say for example you are seeing an indication of 33, that implies an approximate, it's a rule of thumb, 33% change in the price of the S&P. So that's not exact, but it's a rough rule of thumb. And we've seen a big spike in the VIX recently, which is very interesting and certainly something to take note of. Okay, so number 5, we've got the put to call ratio. So this is a very interesting one. It's to do with options again. So effectively, options 101, an investor will buy a put option to hedge against a market decline. Imagine if I thought stock X is trading at 100. I think stock X is going to go to 70, but I don't want a shorter position. What I can do is I can buy a put option with a higher strike than 70. So if the market falls, it could even fall to 0. I still have the option, but not the obligation, to go in and sell that share at its price when it was much higher. So that's what put options are, and investors will buy them to hedge against a market decline. If they do that, this will increase the put to call ratio. So therefore we can infer that a higher put to call ratio indicates more investor bearish sentiment, because they're trying to cover themselves in case the stock market goes down. So you can see the ratio here. This is, again, it's historic for the last 5 years. And you can see when it reached the highest was when we had the FANG correction, where tech stocks, they fell quite a lot and they were very kind of overvalued in the market. And also when we had the COVID crash in March 2020, the put to call ratio was very, very high there. So it seems to be, again, a very good indicator of a potential market crash. I will just say though, another misconception of this, a lot of people might be thinking that like 1 would be the base time long-term average of put to calls, but usually more investors buy calls than puts. So the long run average ratio is usually about 0.8 because investors buy 20 to 25% more calls than they do puts. And it's usually a ratio greater than 1.1. That's where you consider it pretty bearish. So you can see 1.1 on the graph, and you've got these various spikes above 1.1, 2 of which are highlighted were very kind of significant times where the S&P fell by a long way. Okay, so that was the 5 main indicators. I really hope you guys enjoyed it. I think I'm going to do in-depth videos on some of them, like covering them for a full video in the future. But yeah, let me know what you guys thought. Any questions, put them in the comments. And until next time, happy investing.